This is your daily real estate syndication show, and I'm your host, Whitney Sewell. Today is a highlight show that's packed with value from different guests around a specific topic. Don't forget to like and subscribe, but also go to lifebridgecapital.com where you can sign up to start investing in real estate today. I hope you enjoy the show. Our guest is Jeff Schechter. Thanks for being on the show, Jeff.
Thank you for having me, Whitney. I'm happy to be here.
Yeah, I'm happy to get into this conversation. And Jeff started his first business right out of college, and over the years been involved in numerous business ventures. His love for real estate investing began in the 1980s when he rehabbed 5 of his own residences before the term house hacking even existed. Since those early days, they've torn up kitchens and bathrooms. He's bought and sold many properties and is an active investor to this day. In addition to investing, he operates a private consulting practice. He thrives on helping people realize their full potential, not just in business and investing, but in all aspects of life. So Jeff, give the listeners a little more about just what you're doing right now, your background, maybe in real estate and your focus right now. And then, I loved what you mentioned before the show about, improper systems will keep things broken or from happening. I'd love to dig into that a little bit, but go ahead and tell the listeners a little more about who you are.
Yeah, sure. So, obviously by that, thank you for the nice intro. And in there, we talked a little bit about house hacking, and, I've been a pretty scrappy guy and an entrepreneur my whole life. And probably between the 2002 to 2008 period, I also had a flipping business. So among other things, I kind of eventually graduated from just house hacking into actual flipping. And we all know what happened in '08 and got my ass pretty much handed to me on a silver platter and started over. And at that time, I was very curious about internet marketing and moved to Austin, Texas. I was living in San Antonio, and there's a great digital marketing community there, and I got very involved in all that stuff. And that's ultimately, through some consulting, how I met my current partner. He was actually buying some properties in Indianapolis and getting some pretty good returns. And we started learning about this concept called turnkey, which I had actually, even though I was involved in real estate, had never really heard about before. And I gave him some marketing advice that he really liked, and invited me to become his business partner. So today, I now live in Indianapolis, Indiana, and we operate a very, very successful turnkey company. And for those of you who don't know what that is basically we just provide an end-to-end system for investors. So, we acquire the property, we rehab to certain standards, we have our own property management team, we place the tenant, we get it performing, cash flowing, and then and only then do we sell it off to investors as a performing asset. So that's kind of what I'm up to now, and it's been a challenging start, but we're very excited about where we are now because we've finally got a pretty decent and successful company.
Nice. And, what I appreciated too, like before we started recording, was just how you mentioned the key to your success has been in systems. And I'd love for us to get into that and you elaborate on these systems that have helped you to be successful. Whether it's syndication, or whatever type of real estate or any business, really, you got to have some systems in place if you plan to grow, right? And so, let's dig into that and please elaborate.
Well, there are about 10,000 examples that I can give you, but I can tell you where it starts is from really making some really, really stupid mistakes. And some of them were really, really big, devastatingly financial mistakes. And it started with the question, obviously, how can we keep this? How can we prevent this from happening again? Because otherwise, we're not going to have a business. I mean, there were just really, really big, stupid mistakes. So when we first started our company, we would just go out and find a property and we would actually rehab it while it was owned with the investor. Like our logic was that, hey, if we sell to the investor shortly after we purchase, we kind of eliminate our hold times and our hold costs. But then what happens is we run into mistakes and we run into surprises on rehabs and things like that. And then we're already in bed with the investor, and there's ourselves here in Indianapolis, an investor maybe somewhere in California, helping to make the decisions. So, it's a classic case of too many cooks spoil the pot, right? So, then from there, we'd get the thing finished, and sometimes it would be a few days, sometimes it would be a few weeks, and sometimes it would be a few months until that property got leased out. And the entire time, of course, the investor is freaking out, going, where's my cash flow? Where's my cash flow? So when we finally started recognizing, like, okay, the money that we're saving on hold costs by selling it early is absolutely not worth it. And we made a decision to say, we are only going to sell properties after they're done being rehabbed. Once we know exactly what our costs were, all that kind of stuff, we can make a fair profit. We can get to some fair numbers for the investor. It puts us on the hook to make sure that the end price is obviously something that's attractive to the end investor from an ROI standpoint. So it puts the responsibility on us. We then were still selling properties that weren't quite tenanted and ran into that whole issue with investors waiting for stuff to be cash flowing. So ultimately, even though, again, it increased our hold times, we went to a situation where the only properties that we would sell were after they were performing and stabilized and things like that. So, those were some pretty key decisions in our evolution. And the other one that was really probably the biggest one, and this doesn't matter whether you're in syndication buying one property 500 or the tallest skyscraper in the world, but unless you have a property, there's only two things that equate to success in a real estate investment. One is you got to have a property that's in good condition. Secondly, you have to have a happy tenant, because if either one of those is out of whack, you are going to have problems and you're going to have expenses that are beyond what you had anticipated. So you have to start from there in any project. And I see a lot of even syndication products that don't start that way. And it's unfortunate where the building that they're getting into is not necessarily rehabbed, and they don't necessarily have the right marketing for the right tenant, and it's not maybe necessarily the right use of that building. There's lots of different ways that can go awry. So those two things you have to start. So we started looking at, we offer a warranty on our property. It's all the major systems, obviously roof and HVAC and foundation and, electrical, plumbing, et cetera. And as soon as we all know this, as soon as tenants start getting into properties, whether they're commercial tenants or residential tenants, they're going to put that property to the stress test, right? They're going to Sure. They're going to test the plumbing. They're going to test the electric. If the roof's going to leak, it's probably not going to leak the day before they move in. It's going to start leaking, ironically, the day right after they move in, right? So we were on the hook for all these warranty issues. So in addition to doing this rehab, now we're having to come back and start fixing properties that we thought we already fixed them. So probably the biggest system that we ever put in place was we really, really got our rehabs dialed in. So we said, hey, look, when we go acquire the property, we have some pretty good teams, and we use some internal teams and some external teams for the contracting. But what can we do in terms of a third party out there that might be able to tell us the condition of the property? We thought, hey, why don't we do an inspection up front? Let's just pay some impartial third-party company. What's it going to cost us? $300-$400 to go and find out exactly what's wrong with this structure. Then we go and we send our teams, and we've developed a 41-point checklist. So we check everything and subflooring, and are the toilets on straight, and is the stress test of the plumbing, and obviously we turn all the utilities on first.
Our guest is Sakar Kawle. Thanks for being on the show, Sakar.
Awesome. Thank you, Whitney. I appreciate the invite and looking forward to the conversation.
Let's talk about value add just a little bit. It's a term that we hear often, in this industry, and value add deals. And, those types of deals have been, have made a lot of success for a lot of operators over the last many years.
Sure.
And I know you're very familiar with value add, and you all have been doing that. What's your take on, say, value add, now, value add deals, completing that type of business plan now, today, as opposed to, say, 5 years ago?
Sure. And that's a great question, Whitney. Value add gets interesting, right? So for newer folks who may not know, there's a huge difference between a value add versus capital improvements. Like value add would be, you'll say, okay, you're adding amenities, like perhaps it's washer dryers, Amazon-based lockers, or, you're probably offering, some, let's say, water-based conservation program and things like that. But the other things, as far as the roofs, the windows, or perhaps the expensive siding or the expensive, let's say some of the landscape landscaping or sort of the curb appeals and things, they start to get expensive, right? That's where you have to differ. Like, for example, if we take the pandemic out of the context for a second, last several years have been very much forgiving to investors, where we had record appreciation, you had markets going up and things like that, rents were obviously going up. So you had a sort of a situation where a lot of mistakes, or perhaps some things that you would have missed during your initial underwriting, you were forgiven by the market. But now we are in a situation where I think you have to accurately underwrite the deals, accurately understand that, yes, what exactly the value add improvements we are doing, or what could be the capital improvements that are definitely needed in our business plan to get where we need to be, right? So that's where you have to distinguish that it's not a forgiving environment as we have had before in the prior years. Now it's all about, let's get our budgets right. Let's make sure we are taking the estimates correctly from, let's say, the contractors, or let's network with a few more property managers and understand how the assets will perform, what sort of rent bumps, if any, you are seeing. So you are not banking on, like, let's say, the market or the tailwind concept, as we keep talking about, that the markets and the rent appreciation that you might get. It's not there. So it's all about making sure your underwriting is correct, your budgets are accurate, and you're not overly aggressive in your assumption. That's what I would say. It kind of dovetails into a lot more bigger issues, that it's not about, hey, can I apply the paint, and can I maybe do a little bit of landscaping. It's a whole lot, given the pandemic and all the sort of the headwinds we have, given with all the rent decreases we may see, right? So it's all about making sure that all of those things are correctly accounted for in your underwriting. Otherwise, you could be working for free in your syndication partnership that you would have, and not see that many good returns. But that's the world we live in right now,
Yes, no, you mentioned so many great things there. And one thing I wanted to ask you, you said you must accurately underwrite deals now and understand your value add. It's so true. We thought we needed to know that, all this time, but
Sure.
We understand now. I mean, it's so much more even crucial, because like you mentioned, things were forgiven then just because of the market. So, if you could pick, just two to three things when you think of underwriting accurately now, and nailing that down even more accurately than we did, say a few years ago, what would that be? Or, what are some things that you focus more on now?
Sure. I think right off the top, as you are, let's say, underwriting the deals, I think networking with property managers, in my opinion, is a great way to understand that how the property will operate, right? And that means that is the property management companies that you're working with, are they giving you realistic budgets? Like, are they going to perhaps charge you a bunch of fees, or perhaps are they going to charge you a lot more overhead on top of, like, let's say, if you're doing some value add improvements or leasing and things like that, are they going to charge you more fees? So that would be one bucket I would look at, right? On a consistent value add basis, like, water savings always play a great role to your bottom line. Like, without doing much, if you can change and do the water conservations and save some energy, that goes right back to your NOI. We have seen the water savings programs give you returns in that, like, sort of around 15 months. So let's say if you're spending X dollars, through the savings, you see that, yes, you're gonna break even around, within 15 months or so. Those are the quick few things. And then, obviously, like, let's say if you're buying a tired property, quick landscaping improvements, and instead of doing expensive, retars on your driveways and things like that, if you can just seal coat and, get by, those would be good improvements. So anything that you can do for a less dollar, whether that's just, let's say, power washing your siding to, kind of get by first, let's say 24 months or so immediately before you can go into an expensive, let's say repainting or changing the entire of your siding. So anything that you can do perhaps to kind of weather the storm right now, and then see how things come out, and then after, like, let's say 18 to 24 months, you want to revisit and say that, okay, now I'm going to jump on some of the expensive CapEx improvements that I have to do. So all those things should be on the table to kind of get by right now, and then perhaps launch into, perhaps a full-scale CapEx plan that you may have.
Thank you for being a loyal listener of the show. Please subscribe and share it with your friends. We want to help you become the passive investor you've always wanted to become, but also the operator you've always wanted to become. We want to be the number one resource for your real estate investing journey. But go to lifebridgecapital.com where you can start investing in real estate today.